Portfolio manager at Toews Asset Management. Phillip, thanks very much for coming on the show. So your concern here is that people think, well, I'll just hold my 60% equities portfolio, my 40% bonds, and that tends to get you through pretty well everything. But you think that's misplaced confidence?
It is. In my book, one of the, I believe, the most revealing things that I talk about is the fact that we're really ignoring a significant part of history. If we look back over the last 30 to 50 years, 60-40 would have worked reasonably well. But if you look further back, there are two things that really stand out. The first is a bond bear market that lasted for 36 years, Andrew, between 1945 and 1981. Fixed income investors would have been obliterated during that. But the big one really is the Great Depression. And if you take back and visualize what a balanced portfolio would look like during the Great Depression, in the first 3 years, Andrew, a balanced portfolio after distributions would lose 72%.
Wow.
So imagine being left with 28% of your portfolio. We rallied in fits and starts for a couple of years and then had another through 2 or 3 more years of bull markets, but then we had a 5-year bear market at the end of that. So people would have run completely out of money ultimately if they were distributing out of a balanced portfolio. So in the book, I lay out a new quantitative framework, a new way to think about building portfolios that is slightly different than a balanced portfolio.
Give us an idea here. I mean, presumably if you held cash, at least you wouldn't have lost as much money. Is that one option in this new type of portfolio thinking?
Well, so what I talk about in the portfolio is this behavioral portfolio actually starts with a conventional construct. So if you're a 60-40 investor, you start with that, but you make 2 crucially important changes. The first is take half of your equity portfolio and put it into something like hedged equity funds, things that attempt to correlate in up markets, but attempt to uncorrelate during falling markets. Put the other half of your equity portfolio in just conventional equities, indices, and things like that. What that'll do then potentially, Andrew, is it'll give you exposure to, that 60% of equity portfolios, but for at least half of it, you can attempt to uncorrelate during falling markets. The other big change, Andrew, is for fixed income, put that into something that's adaptive, like an unconstrained bond fund that can be, as you pointed out, something like T-bills or cash during certain kinds of markets, but it can also move into investment grade bonds or high yield bonds. And while you may not always earn above inflation returns for that portion of the portfolio, that's at least designed to attempt to not lose money if interest rates rise or inflation gets out of hand.
So I'm thinking about people's access to hedged equity products. I mean, a retail investor can't get into a hedge fund, or a smallish retail investor. Would you recommend, for example, selling puts, index futures, selling puts?
Well, so there is actually exposure to the retail investor through things like buffer ETFs, or hedged equity mutual funds or hedged equity ETFs. So These things are tradable by investors. For a lot of people, it's a new category, but certainly here in the US, it's a big thing, but there's also access in Canada. So yeah, we'd strongly recommend just allocating that. In most cases, you can allocate to those types of products right on your platforms, right where your money lives right now. So it's not something just for wealthy investors.
On that half of your equity portfolio that you're hedging, obviously you will be giving up some returns. Hedging isn't free.
Exactly. So the idea is this, the efficient markets hypothesis is, has a lot of data that says this is the best way to get a rate of return. But what investors want really is a decent return, but they want less exposure to significant risk. So right, what you're doing is you're agreeing to say, like, look, we'll move the overall mean returns of the portfolio down a bit, but we'll take that budget, the money that we spend for that, and spend it on the desire to try to reduce risk of extreme markets. And I got to say, Andrew, if you read the book, if you read the first third of the book, I don't think you can come out of it with the same perspective on investing, because what you realize is, oh, wait a minute, things can get way worse than they have over the last 30 years. We really need to address this in how we build portfolios.
That was interesting what you said about bonds. So they went into a bear market from the end of the Second World War when I guess bonds were in demand, people looking for a safe haven, right through to around 1980 when interest rates spiked?
Andrew, 36 years, if you can imagine that. But look what the conditions were at the beginning of that. That was just post-World War II. Here in the US at that time, we had 100% debt to GDP. Does that sound familiar? Anyone? And the 10-year Treasury was yielding around 2% in 1945. So it was the run up from that 2% level all the way to 14%. That was accompanied by two major inflation episodes, one in the 40s, one in the 70s and 80s. So that's the potential problem here, is that our starting place, if you look back where we started at the end of 2021, gosh, the 10-year was even lower than it was in 1945. So, we've actually had a bear. You could argue to some extent that we are in a bear market for bonds, and we had a little rally over the last year and a half to 2 years, but it could continue, especially if inflation gets reignited here.
It does feel like we're in new territory right now on the political front with, for example, America wavering in its support of NATO.
In my estimation, we're completely underestimating the overall global economic impact of tariffs. And even the most studied analysis right now are talking about here in the US, maybe, it'll be a 0.5% contraction in GDP. That's complete bunk, especially if you look at the reaction of Canadians as an example to some of the tariffs and how there's a refusal or desire to boycott American goods. Imagine what's going to happen on April 2nd. The administration calls it Liberation Day. I think we may be liberated from our wealth on April 2nd. So look, the potential impact, if you look back at Smoot-Hawley, which is the last time we had the brilliant idea of massive tariffs in this country, was potentially devastating to the economy. So I think we've got a lot to watch out for. We're completely missing the risk signals here from global tariffs across the board.
Should people hold 5, maybe even 10% of their assets in gold?
It's a possibility. We're not huge advocates of gold because even though it's done well recently, over the very long term, gold just returns about what inflation does. So you're not getting any above inflation returns there. So no, actually, even though it sounds, Andrew would say like, well, there's a doom and gloomer. I don't call myself that. I refer to myself as a boom, kaboomer. You have to embrace the boom, but you also have to address the possibility of a kaboom. And so, backing into what I was talking about before, which is taking a behavioral approach, going ahead and sticking with the conventional construct, because look, I could be wrong. We could see markets rally. Maybe the administration backs off of tariffs. Maybe the global economy grows. If that's the case, you want to be positioned for optimism, but you also want to address contingencies as well.
Phillip, thank you very much indeed. Phillip